The views and opinions expressed in this broadcast do not necessarily reflect or represent the views and opinions of WBGR Network. Any questions or concerns about what is said should be directed to the show host, whose information will be provided upon request.
Hello everyone, welcome back to Let's Talk Money 2020. Today's Friday, I believe it's the 28th or something like that. The days kind of run into each other. But today I'm going to be real brief. I'm going to go right into it. We're going to talk about solving your own tax debts. You see people on television and radio, you listen to people on the radio talk about we can solve your tax issues and whatever, but as I said on previous on videos, you can pretty much solve a lot of the tax debt yourself. I can't say that you can solve everything yourself, but why pay people $10,000-$20,000 to really solve your tax issues when you could do a lot of it yourself. So I'm going to get down to the practical side of actually solving your tax debt. I don't believe in talking so high level that you never be able to understand me, or you won't have anything to take away. I believe in showing you exactly what we do on a day-to-day basis, because if you can grasp some of the things I'm telling you, you can solve your own tax debt. So let's get right into it, okay? Basically, the first thing you got to be able to face the problem. The thing that I see most is people are too afraid to really attack the issue. They see the notices come in, they get afraid. They see the balances climb, and they get kind of get in a state of paralysis where they can't really do anything, and they're too ashamed, and they just let the thing just snowball and get out of hand. But the best thing to do is, wherever you are in the process, the best thing to do is just face your problem. The first thing you got to do is you got to stay current with all your filings, all your payments. So if you want the IRS or any other tax agency to do something for you, the first step you're going to have to do is, like I said, face your problem. The second thing is you're going to have to do is really show that you want to solve the problem. And if you got massive tax debt in the past, the best thing you can do is just kind of put the blinders on to those past tax debts for now, and look at where you are currently, and make sure that you are in compliance currently, because no one wants to really help you if you don't show an effort to really fix the problem yourself, and no one wants to do a deal with you knowing that, hey, look, next year you're going to be in the same situation. So the best thing that I tell my clients is establish a pattern right now, fixing where you are right now. And if you have estimated payments that you're supposed to be paying, start making your estimated payments now. And they may not be able to make the total amount of estimated payments, but start making payments. Show a pattern of you wanting to fix the problem. If you're always late with your tax returns and having penalties and everything every year, start by doing things on time. It shows that you're willing to fix the problem, and from a human perspective, it goes a lot. Now, the computer doesn't make this kind of judgment to say, okay, this person has really been delinquent in the past, but now we see a pattern of year, 6 months, 9 months, 2 years, whatever, of them really trying to do the right thing. Let's help them. Computers don't think like this, but human beings think like this. So if you're if you're the IRS person or the state tax person, and you're looking at somebody that wants to really help their situation, if you're a person that really wants to help someone and you're working in that job, you're going to take the extra step to really help this person really solve whatever tax problem they have. But if you're a person that just does it year in, year after, year out, and you don't show any any remorse for what you've done, you don't see any corrective action, that person on the other end is not going to be willing to help you. They're like, okay, you're in the pile with the rest of the delinquent people. So let's make sure that you get current, you stay current on the filings. It goes a long way. If you have estimated taxes, I kind of said this, if you have estimated taxes, you got to start paying them. They may not be the right amount, but you at least got to show some effort to pay. Today what we're going to do is we're going to cover if your solution is to actually get a payment plan, because that's the most easiest way to actually get yourself on the right footing, is to enter into some type of payment plan. And just give you some general notes on the payment plans. If you talk about the IRS, basically, if you want the minimum amount of payment, then you basically want to take the amount that you owe, the tax amount that you owe. You could take out the interest and the penalties, but just the tax amount that you owe, and divide that number by 60 for 60 months, and sometimes they let you go out to 72 months, and that gives you the minimum amount that you can expect to actually pay. So they will work with you if you want to pay it over long term. However, the interest compounds daily on IRS debt, and most of the state debt the interest rates are very high. So I mean, if that's your last resort and that's the only thing that you can do, you don't have assets that you can actually borrow against, or you don't have the cash to actually pay down the debt, you might be just stuck with just getting a payment plan. It's better than nothing. It's better than getting constant notices, constant threatening notices, them attaching your bank accounts, your salary, and that sort of thing. Because once that you get a payment plan, they really are supposed to stop really the aggressive collection tactics that they can deploy. They have to stop those once you enter into a valid payment plan. And then once you accumulate more debt, in most cases it will actually default your installment agreement. So it's better to just stay on track, stay compliant once you get into the payment agreement and before you want to enter into the payment agreement. So we're going to cover payment plans today, and I'm going to give you a little bit more as we go on what to do. All right, so like I said before, the first step you're going to have to do is just make an effort to actually get current on 2020 estimated taxes. It shows that you're willing to fix the problem. So I don't want to talk any more about that. I think I did a good job of really explaining what that is. All right, step 2. All right, here's the thing that most people overlook. So say if you got federal taxes that are due, and they want you to fill out forms to actually do a payment plan. The first thing you should really do, one of the first things you should really do, is you should establish your court-ordered payments, your state payments that might be outstanding. Get a payment agreement with them first. Get a payment, get on good terms with your student loans if you got outstanding student loans, and develop a payment plan with the student loans. Get on some kind of program. There are plenty of programs with your student loans these days. And then any other type of secure debts, like court orders, alimony, divorce, or any other court orders or judgments or whatever that you might have, get those solidified first. There's a reason why I'm telling you to get those solidified first. It's because when you are filling out the IRS income and expense worksheet, which we'll get to in a few minutes here, when you're filling that out, they're going to give you credit for these court ordered or payments that you've already set up with the state agencies or federal agencies for that matter. They're going to allow you to put those expenses on your estimated amount that you could actually pay to the federal government. So why not get these done first, right? If you owe tax debt, right, and you try to get a federal payment plan, and say you owe over $25,000, then they're going to want you to give documentation on your assets, liabilities, and other things in order to enter into a payment plan. So what you want to do is you want to get these things solidified first that I just mentioned, so that you can put those on the form, and then that's less money that the IRS can get from you right now. I mean, they're going to get whatever's remaining out of the allowable expenses, but at least you'll have those things added. So this is the part that people kind of overlook. All right, this is very important because if you don't have the agreement, it's not solidified. If you say pay your state taxes $100 here, $200 there, $75 there, that's not a plan. That's not something that you can put on your financing documents and say, look, I'm on the hook every month for this amount of money. So get those agreements is very, very important. Okay, so the next thing is, I mentioned this in the past as well, is statutory period analysis. What this means is, say the IRS debt. The IRS has 10 years to actually collect the debt, and if they don't collect in 10 years, I'm saying 10 years generally because there might be some things that extend that 10 years, bankruptcy, offering compromises, and some other things that might extend the 10 years. But generally speaking, the IRS has 10 years to actually collect that debt, or the debt has to go off your record. All right, so states work a little differently. States generally don't have a statute of limitations. Why? I can't tell you the answer to that. But the statute of limitation analysis is very important because if you're trying to enter into a payment plan, then you want those debts to actually drop off before you enter into the payment plan, because what's that going to do is that's going to lower your minimum payment. So if you have people ask all the time, how much should I really establish for my payment plan? And my answer is always, settle for as low a payment as you can, but make higher payments every month. And the reason why I'm telling you to do that is because if there are months where you can't make the payment, or the months you can't make as much, at least you can cover the minimum amount, but you have to be disciplined and pay more than what's minimally required of you. So the IRS is going to actually require that you have the money automatically deducted out of your account to save you on some processing fees and whatever. You can do that, but you can add more to that. So what I would do is I would go for the minimum payments and just add more to it every month, right? Nothing stops you from adding more on as far as your payments are concerned. So statutory limitation, again, the IRS has 10 years to collect from the legitimate time that the debt becomes official. Have 10 years from that date to actually collect. So, and the states don't have that statute of limitation. Okay, so the next thing you have to do is you're going to have to prepare, if you want a payment plan, you're going to have to prepare what's called a 433A, 433B, or 433F. Let me tell you the difference between all three before we actually get into one of the forms. All right, so the 433A is for individuals. So basically, they're trying to assess your ability to actually make payments. That's the bottom line between the 433A, B, or F. They're trying to see how much you can reasonably pay every month. So what they're going to do is they're going to ask you for where you work. They're going to ask you for your family composition, your household income. They're going to ask you for your assets, the value of your assets, your liabilities, how long do you have to pay on these liabilities, life insurance, stocks, real estate. What they're trying to see is, do you have assets that you could actually tap into to actually pay off your debt or to pay down your debt? So this is what this is really for, and the end result is they're trying to figure out how much you can actually pay on a monthly basis. There are supporting documentation that you have to submit along with this: bank statements, mortgage statements, your lease if you're renting, car payment statements. There's a lot of things that you have to add, and if you look at the instructions, and they can tell you what to really add with it. So the difference between a 433A and say a 433F is the department that's actually asking for the data. So for example, if you are in collections, they're going to ask you for a 433F. Basically, they're the same documents, the 433A and the 433F. They're for individuals. They ask for the same information, basically. The 433F is supposed to be shortened, a little easier to answer, but the questions are pretty much the same. It's just that it's a different department asking for it. And the collections department usually asks for a 433F. If you're dealing with appeals or other other agencies, they might ask for a 433A. Also, when you're doing an offer and compromise, I think it's a 433 OIC, I think it is, but the information is pretty much the same information. And a lot of times the agency would take either or, but I know in collections, the official form that they will ask for individual is a 433F. So 433B is for businesses. So if you have a corporation, S corp, or so forth, they want to know information on the business. That's done on a 433B. All right. So what I'm going to do is I'm going to pull up the actual form. I'm going to talk about the actual form because people get intimidated by the actual form. So basically, they want to know just about everything about you. They're trying to collect the debt. Don't get it wrong. They are trying to collect the debt. So they want your name, address, where you work. You got business tax IDs. They want your business tax IDs, number of employees, so forth. This is the 433F. They're going to want your personal bank accounts, the amount that's in your bank account, the bank account number. Look, I mean, don't worry about filling out these forms. Trust me, if the IRS wants to know where you bank at and you owe debts, they're going to find out where you bank at. So this is not a secret. I mean, there may be cases where they can't readily get the information as far as where you bank, because you might be banking at a small bank and they might not necessarily reply to inquiries as fast as some of the bigger banks. But eventually, they're going to find the smaller bank, the credit union or whatever. They'll find that eventually. But it is harder to really trace the smaller banks because they don't have the apparatus to really report to the IRS like the larger banks do. But I'm not saying that you put all your money in a small bank, which sometimes it is beneficial to do that. But for this purpose, I'm not saying one is better than the other. I'm just saying they're going to find out where you bank anyway. So people always say, hey, I don't want to put my bank account information on there, but trust me, they can find out. They want to know about your investments, stocks and so forth, IRA accounts. Well, actually, this is not the stock section, but the IRA accounts, retirement accounts. They want to know more about that. Actually, this is the stock section. So they want to know what the value is. Again, they're looking for if you have assets that you could actually tap into to actually take care of your tax situation. They're not going to ask you to withdraw from your IRA account, especially if you're under 55, because there's a penalty. They won't ask you to withdraw from those accounts, but if you have some accounts where you're not going to have to be penalized and so forth, they may just ask you to actually liquidate those accounts to actually pay off your debts. Cryptocurrency is something new that they have on here. So if you got a lot invested in crypto, they want this information. Of course, with the new age, they're adding stuff like that onto the documents. Real estate, they want to know what real estate you have in your name. If you own some real estate jointly or joint by entirety or whatever, they may not be able to come after that real estate. But if you show a lot of equity in your properties, this is what this is basically for, to trying to see how much equity you have here. So if you got a lot of equity in the properties, then this is not going to help you much. They're going to really basically ask you if you could actually borrow against some of the properties. And if you're showing a bunch of equity and you got a lot of debt, they're going to want you to apply to banks to see whether you get approved to actually pay off some of your tax debt. I mean, that's an extreme case, but I have seen it happen where they want you to at least try to actually borrow and get money from assets that are secured by real estate and you have equity there. So other assets, it could be cars, antique vehicles. It could be, personal items, jewelry, that sort of thing. That's your other assets. Credit cards, they're trying. I have not seen a case where they ask you to go into debt on your credit cards to actually pay off your loans. So I'm really thinking what they're doing is they're trying to see whether you make priority as far as paying off your credit cards over the IRS debt. If they have a choice, they want you to pay off the IRS debt instead of the credit card debt. Like, for example, if you pay you have a $10,000 limit on a credit card, and you're used to making $2,000 a month on the credit card. Well, that 2,000, well, not the whole 2,000, but maybe 1,500 of it could go to IRS debt and not go to the credit card. So they would prefer you to actually, have the interest with the credit card company as opposed to having the interest with the IRS. So, and they're not going to force you to go and draw to your limit. I've never seen that, to be honest with you. I think they're using that for other purposes. They want to know what people owe you. This is your accounts receivable. So this section is not as verifiable. I mean, if you got credit cards, bank accounts, or whatever, you can pretty much verify that. But it's kind of hard to verify what people owe you. If this is the case and you want to go this route, I can see where you would use a strategy where if the IRS was playing hardball with you and they would not set up a payment plan, you could actually boost these numbers up to really say that, hey, look, no, I have these people that owe me, I just can't get it now. They'll have it in 6 months or whatever. Then that might be leverage to actually get into a payment plan, or force them to get you into a payment plan now. And they might just have a situation where you pay a lower amount now, and 6 months later, year later, when you do get these receivables, we're going to ask that you step it up. So this is one of the reasons why they're asking for this type of information. I've been in this business for a long time. I know why they're asking for certain information. All right, so this is your information on your business account. We already talked about that. They want to know your employer, who you work for, how much you get paid. Because what they're trying to do is they're trying to say, okay, well, this is the amount of money that he collects every month. These are expenses every month. And after the expenses, this is what the IRS, what is due to the IRS every month. They want to know certain things like the other type of income, like, for example, your alimony, child support, self-employment income, rental income, unemployment income, pension income. They want other types of income in here as well. Again, they're trying to see how much you actually collect every month. To see whether see how much that they can collect from you as well. So that takes me to the monthly necessary living expenses here. There are allowances that the IRS will give you based on food, housing, clothing, whatever, what you should have here. These are not the allowed numbers. These are some numbers that we use some samples, and we actually left these samples in here. But remember when I talked about some of the agreements that you should really enter into first? This is where this comes into play. Like, for example, if you have, state taxes, if you see on that form over there to the right, you see delinquent state taxes. See, if you would set up your payments, you can actually put your payment and your documentation along with this. Your court-ordered child support, you can put that on here. So this is money that the IRS will allow you to actually say, okay, we're going to allow him to pay for this, and this won't go into our calculation as far as how much we want as the IRS is concerned. This is why I was saying before, you want to get those agreements solidified before you actually do this 433A, 433B, or 433F. Get those agreements first, right? Before you go here, so those can be accounted for, because you put up at the top how much you make. They're going to start subtracting all this stuff away from how much you make. So once you fill out this, if you look at the bottom, they're gonna have a net number. They can really figure out a net number, how much they can reasonably collect at the end of the month. Now the IRS does have say so. They can come back here and they can say, we're gonna disallow this, we're gonna allow that. We're gonna actually increase your number if your number is way below the national standard. You can ask that they increase the number. So it's important to know what the national standard numbers are. They are published out there. They're not secret. So the final thing is what you're going to do is you're going to actually give them as much supporting documentation to really support these numbers, whether it's income, whether it's expenses. You're going to put for the last 3 or 4 months the backup information on these numbers on these expenses that you're paying and the income that you're receiving. So you can give them council checks, you can give them bank statements, just anything that would actually support these expenditures. It could be electric bills, it could be mortgage statements, car payment statements, anything you could use to actually receipts, anything you could really use to really support your numbers here. And they're stickler for these things. They have to have these things in the file. So don't think you can just fill out the form and this is it. No, they're going to want the supporting documentation because there's two reasons. One is they want to verify. That's the obvious thing, they want to verify. But the second thing is the person who's actually recommending your installment agreement has to really cover themselves to make sure that the numbers that you have on your return, on your form makes sense. So the way it works is they're going to get an approval. It has to go to a manager for approval, and then there's another party that actually approves the installment agreement as well, and then it has to pass through that approval process in order for you to have an official installment agreement. So make sure that you have the documentation, and then there are some instructions on the back here on more. They go more into detail. I've probably given you more detail that's in the instructions here because I've been doing this for a long time. So all the instructions are here, and like I said before, you don't have to pay people, large sums of money to get this done. If you don't like the payment agreement that you've come up with the IRS, you can go later and pay somebody to actually negotiate for you, or you can give it another shot. You can after 3 or 4 months have gone by, you can give them another 433A, B, or F. To modify the numbers if you want to. So don't feel like this is something that's etched in stone. It can't be changed. No, it can be changed. If your circumstances change, then you can submit other documents to get these things approved. Now, sometimes you don't have to give this information. If you're an individual and you owe less than $25,000, you can go online and just set up a payment plan. And no questions, nobody's going to ask you any questions. They're just going to set up a payment plan based on the minimum amount that you should be paying on the whatever debt that you have. If it's under $25,000, if you're an individual. For businesses, I believe it's $50,000. You got to have that number less than $50,000 for no documentation. So if you are over, for example, you can actually pay to get your numbers under the $25,000 or the $50,000 minimum amount there. So I think I'm going to stop right there. I've given you tons of information here. Go back and listen. But you can do a lot of this stuff yourself. Doesn't take an expert to really do this. You just have to get over the fear and just do it. Next week or in the upcoming weeks, I'll go more into the 433Bs if businesses owe money, and if you want to try to solve some of the stuff on your own as a business owner. There's also some other strategies you can do as far as your negotiation with the IRS. There's offering compromise. There's abatement of penalties and interest. There's certain things you can do to actually might be a better strategy for you, but this is the easiest route to go, and this is just to set up a payment plan. You might want to set up a payment plan as a precursor to actually doing your overall another plan later on with the IRS. But remember what I said before, you got to show a pattern of really doing the right thing and paying. So this is really some of the first steps to really get you going. So with that, I think we're going to end for today. Looking forward to next week. This is what I do every day for a living. I like talking about what I do. So look forward to other videos talking about similar issues. So until then, take care, stay blessed, and I'll talk to you soon.